Comprehensive problem under interest on pre-construction period. Let me go for practice 11. Mr. Albert owns a big house. Construction being completed in 30th November 2020. That is the date of completion of construction. So the year of completion of construction will be 2021. 60% of the floor area is let out for residential purpose on a monthly rent of 32,000 per month. However, this portion is vacant for 1 month during 2021-22. 20% of the floor area is used by the owner for the purpose of his business, while remaining 20% of the floor area used for his residence. Other particulars of the house are as follows. Municipal rental value 6 lakh, fair rental value 5 lakh 60, standard rent 6 lakh 40,000, ground rent. Actually, this information is unwanted for income from house property income computation. Annual charges, also unwanted information. Municipal tax, this one is required. Insurance, unwanted. So in this problem, ground rent, annual charge, insurance are unwanted informations. On 1st June 2018, he borrowed 5 lakh at 12% per annum for the construction of property. No any part of loan settled yet to date. Compute taxable income from house property. Let me see the answer. Computation of taxable income house property. Actually, 20% of the portion was occupied by the owner for his self-business and 25% for the self-residence, and the 60% is let out at 32,000 per month. It was given very clearly. This let out portion also vacant for 1 month. So we have to claim vacancy allowance also. So let me start. First, so 20%, 20%, 60%, 2:1 or 1:1:3. We will always give the first preference for the self-business because any interest on loan for this property will be debited in the profit loss account but not under income from house property. So please remind this information. Now we start the answer. Municipal rental value 6 lakh. So 2:2:6. On the proportion we shared here. Fair rental value also shared. Whichever is higher. And compare the standard rent, whichever is least. This value is called expected rental value. For the self-business portion 1,20,000, for the self-residence portion 1,20,000, for the let-out portion 3,60,000. Less annual rent because the third portion, 60% portion was let out at 32,000 per month. Annual rent. Less unrealized rent, etc. So 32,000 to 12, 3,84,000. This value is called annual rental value. Less vacancy allowance 1 month, so 32,000. Balance gross annual value for the first portion 1,20,000, second portion 1,20,000, third portion 3,52,000. Here we can deduct municipal tax, totally 60,000. So 2:6 or 1:1:3. So 12,000, 12,000, 36,000. So balance annual value for the self-business portion and the self-residence portion. We cannot show the annual value, some amount for the let out portion. Please remind this one. Do not show annual value for the let out portion. Next, self-business exemption under section 22 for the 20% first portion. Next, less self-residence exemption under section 23 subsection 2. 100% the annual value is exempted. So the net annual value for the first portion, the second portion will be 0. For the let-out portion, 3,16,000. Here, less deduction under section 24 class 1, we can avail standard deduction at the rate of 30% of the net annual value. Next, interest on loan. In this problem, we have to compute interest on loan because the loan amount and the date of borrowing and the date of completion of construction, everything was given clearly. Based on that working, we have to compute interest on loan for the current year and interest on loan for the pre-construction period. Let me start the workings. Loan 5 lakh, interest rate 12%, period. Date of borrowing 1st June 2018. Date of repayment not yet made. Date of completion of construction 30th November 2020. So the period equal to 1st June 2018 to 30th November 2020. That means during 18, 19, 10 months, June to March. During 1920, 12 months. During 2021, 8 months. But 2021 is the year of completion of construction because the date of completion is 30th November 20. So accounting at 2021 will not be considered for interest on pre-construction period adjustments. So ignore that one. So balance only 22 months only will be considered. So interest on pre-construction period equal to loan into rate into period by 5 years because the maximum time limit is limited to 60 months. 60 months means 5 years. So loan amount 5 lakh, rate of interest 12% into 22 months is a pre-construction period by 12 because it was accounted in terms of months. That only 22 by 12 we are putting here. By 5 years, amount will be 22,000. That is pre-construction period working. That should be allocated in the ratio of 2:1. So for the first portion is the self-business portion that will be recorded only in the profit and loss account of. So it will not be recorded under income from house property. And the current year interest, the full 5 lakh into 12%, 60,000. That 60,000 will be apportioned in the ratio of 2:1. So 12,000, 12,000 and 36,000. But this 12,000 will be recorded in the profit loss account as a business nature expenditure. In the 4,400 will be also recorded in the profit loss account as a business nature. That should not be recorded under house property. So the final income from house property for the residence portion shows a loss of 16,600 and for the 60% let out portion shows income of 1,72,800. In the same pattern, the listeners can practice exercise 11 for their easy understanding. Now next, periodically occupied and periodically let out properties. What is periodically? For the example, in our accounting in April to March, 4 or 5 months only let out the property. Balance months, that portion will be occupied for the self-residence or self-business. In this nature, the number of months let out, that let out months only be considered for tax purposes. Okay, let's see. Practice 12. From the particulars given below, compute income from house property which consists of 2 independent units having 1/3 and 2/3 area. Date of completion of construction 1st July 2020. Municipal value 2,40,000, fair rental value 2,70,000. Self-occupied 2/3 portion and 1/3 portion is let out from 1st April 21 to 31st August 21 at rate of 20,000 per month and self-occupied from 1st September 21 onwards. That means April, May, June, July, August only for 5 months. That 1/3 portion is let out at 20,000 per month. So the actual annual rent will be 20,000. It will be calculated only for 5 months. 1 lakh is the annual rent. Municipal tax 24,000 per annum. Fire insurance, that is unwanted information. Ground rent also unwanted. Interest on loan taken for construction, this one is wanted for house property. Let me start the answer. Municipal value 2/3 portion self-residence, 1/3 portion let out only for 5 months. That was I mentioned here. So municipal value and fair rent will be shared in the ratio of 2:1. We have to calculate the expected rental value. With that value, we have to compare the annual rent less unrealized rent, etc. In this property, in this problem, no unrealized rent. So the gross annual value for the first 2/3 portion is 1,60,000 and for the 1/3 portion is 1 lakh. There's municipal tax. Municipal tax totally 24,000. That will also be apportioned in the ratio of 2:1. So balance annual value for the 2/3 self-residence portion. That amount was fully exempted under section self-residence exemption 23 subsection 2. So the net annual value for the 2/3 self-residence portion will be 0. For the let out portion 92,000. Here less. Deduction under section 24 class 1. Standard deduction permitted for the second portion. That means let out portion. And the interest on loan. How much interest on loan? Interest on loan taken for the construction 75,000. That should be a portion in the ratio of 2:1 based on the portion of occupancy. So for the self-residence portion 50,000. For the let out portion 25,000. So the net income from house property for the self-residence portion shows a loss of 50,000 and the let out portion got income of 39,400. In the same pattern, the listeners can practice exercise 12. Now see practice 13. From the particulars given below, compute income from house property, which consists of two independent units having 1/3 and 2/3 area. Date of completion of construction is 28/2/2021. 21, that is January, February, or March is a closing year means. So 2021 will be that accounting year. So the 2021 is a year of completion of construction. That year will not be accounted while computing interest on pre-construction period calculations. Please mind this. Municipal value 3,60,000, fair rental value 3,30,000. Self-occupied 2/3 portion and 1/3 portion is let out from 1st April 21 to 31st October. So April, May, June, July, August, September, for 6 months. The second portion was let out at rupees 30,000 per month and self-occupied from 1st November onwards. Municipal tax rupees 36,000. Fire insurance premium unwanted. Ground rent unwanted. Loan of rupees 5 lakh at 12% per annum was taken for construction on 1/10/2017. So the date of borrowing was clearly given. Repayment of loan was made on 1/10/21. So the full loan was settled during our accounting year on 1/10. Our accounting year is 21-22. So in this year, that loan was utilized only for 6 months, April to September. He settled the loan on 1st October 21. So while computing interest on loan for the current year, we have to calculate interest only for 6 months. Mind it. Let me start the answer. Computation of taxable income from house property, 2/3 portion self-residence, 1/3 portion let out only for 7 months, because 1st April to 30 was October. Sorry, 7 months. So April, May, June, July, August, September, October 7 months was let out. So balance 5 months only that portion was self-occupied. That 5 months self-occupancy will be ignored. Only 7 months let out only will be considered for tax purposes. Municipal value, fair rent to be shared in the ratio of 2:1 accordingly. Annual rent less unrealized rent, no. So 30,000 into 7 months, 2,10,000. So the gross annual value for the 2/3 portion is 2,40,000 and for the 1/3 portion is 2,10,000. Less municipal tax, 36,000. That should be apportioned in the ratio of 2:1. Balance the annual value for the self-residence property. 100% of the annual value was exempted for the self-residence under section 23 subsection 2. So the net annual value for the self-residence portion will be nil, and for the let-out portion is 1,98,000. Let's deduction under section 24 class 1. Standard deduction at the rate of 30% for the second let-out portion. Interest on loan. First we have to compute current year interest. Loan amount 5 lakh, interest rate 12%, and the loan was settled during our accounting year on 1/10/21. So April to September, that loan amount was utilized. The current year interest will be calculated only for 6 months. That means 30,000. That also be shared in the ratio of 2:1 based on the nature of occupancy, the area of the occupancy. So 20,000 for the self-residence portion, 10,000 for the let-out portion. And interest on pre-construction period. See the workings? Loan amount 5 lakh, rate of interest 10%, date of borrowing 1/10/2017. To date of repayment of the loan 1/10/2021, or date of completion of construction 28/2/21. Which one occurs earlier? So 28/2/21 is earlier. So the interest period will be calculated from 1st October 2017 to 28/2/2021. During 17-18, 6 months. 18-19, 12 months. 19-20, 12 months. 2021, this is a year of completion, so ignored. So 6 months plus 12 months plus 12 months, totally 30 months. So interest equal to 5 lakh into rate 12% into 30 months. So 30 by 12 by 5 years, that means 60 months. This is also 30,000. This 30,000 also will be shared based on the area occupancy 2:1. So for the loss from self-residence property is 40,000. Income from the let-out portion, 1/3 portion, is 1,18,600. In the same pattern, the listeners can practice exercise 13. Now, one more adjustment. When more than 2 property used by the owner for self-residence, what will be the tax provisions? Better refer this note. When more than 2 property, one for himself and other one for his parent, is allowed, held by assessee for his self-residence, the one which gross annual value is greater be treated as self-residence, the other be treated as deemed to be let-out property. That is, always the deemed to be let-out properties gross annual will be lower. Okay, let me see the practice 14. Compute taxable income from house property of Mr. Khan for the accounting year 21-22 when both the properties were used by him for his self-residence. So the assessee can occupy two houses, one for himself and another one for his parents. Municipal value, fair rental value, standard rent, everything was given. Municipal tax only 100% due, so we cannot deduct it from the gross annual value. Insurance premium unwanted, repair charges unwanted, interest on loan for concession, this one required. For the first house 60,000, for the second house 1,75,000. Rent collection charges unwanted, interest on mortgage also unwanted. Interest on mortgage always unwanted. Interest on loan taken only for the purpose of purchase or construction or repairs or renewals, only required for tax computation adjustments. Let me start the answer. Say municipal value, fair rent, whichever is higher, I have to compare that value with the standard rent. So the gross annual value for the house 1, for parents 2,70,000, house 2. Because in these two property, the gross annual value 2,70,000 for the first, and the house 2 is 3,50,000. Out of these two, which one is greater? 3,50,000, the house 2. So that property granted to the assessee himself, and the lower gross annual value property, house 1, is granted as their parents. Less municipal tax is due, so we cannot deduct any amount from the gross annual value. So balance value is annual value for both the properties. Both the properties were occupied for the self-residence, so we can claim self-residence exemption under section 23, subsection 2. 100% of the annual value was exempted, so the net annual value will be 0. But we can claim deduction under section 24, class 1, interest on loan. For the first house 60,000, second house 1,75,000. So actual or ceiling up to rupees 2 lakh, whichever is the least. So for the first house, that means the house which was occupied by the parents shows a loss of 60,000, and the house occupied by the assessee himself shows a loss of rupees 1,75,000. In the same pattern, the listeners can practice exercise 14 for their easy reference. We'll see practice 15. Mr. Singh occupied 3 flats for his residential purposes, particulars of which are as follows. 3 houses. The income tax department permitted only 2 houses, one for the assessee himself and another one for his parent. But the third portion, definitely it will be treated as deemed to be let out. Which house will be taken for deemed? The house which house property's gross annual value is lower, that lower GAV property be treated as deemed to be let-out property. Please mind it. Now we start the practice. Municipal value, first house 90,000, 60,000, 40,000 respectively for house 1, house 2, house 3. Fair rent 1,20,000, 56,000 and 45,000 respectively. Standard rent, municipal taxes, financial premium unwanted. Interest payable on loan borrowed for purchase of flat 1 before 1,499. If any loan borrowed before 1,499, the interest on that loan is limited to 30,000 for the purpose of income tax provisions. And house 2 and house 3 after 1,499 means actual interest or ceiling amount will be 2 lakh after 1,499 means. Please understand the concept. When the loan borrowed before 1,499, the maximum ceiling on interest on loan is 30,000 only. After 1,499 means up to 2 lakh we can claim. Determine the taxable income. Let we start the answer. Particulars: house 1 assumed for own, assumed for parents. House 3 deemed to be let out. It was not directly. First of all, we have to go for municipal value, fair rent, whichever is higher. Compare that value to which standard rent, whichever is lower. We see the gross annual value for the first house 80,000. So the first house granted for the assessee for his own. And second greater gross annual value is 60,000. This 60,000 be assumed for their parents. And the third one is 25,000, very lower gross annual value. This property be treated as deemed to be let out property. Others are same. Less municipal tax, balance annual value for the house 1, house 2. we can claim self-residence exemption for house 1, house 2 because these properties were occupied for the self-residence. So the net annual value will be always nil. And for the third portion is the 21,000. Here less deduction section 24 class 1 standard deduction 30% as usual. And interest on loan for the first house they paid 40,000. That is limited to 30,000 only. For the second and the third, 75,000 and 5,000 fully allowed. So the loss for the self-residence, which is owned by assessee himself, shows 30,000. Loss from house property, the property which is occupied for the parents, 75,000. Income from deemed to be letter property 10,700. In the same pattern, the listeners can practice exercise 15 for their easy reference. The last adjustment is when unrealized rent recovered, the owner of the property not received the rental income of the property from the tenant at any cost. If the previous year's unrealized rent collected during this year, that rent be treated as current year's income, only 70%. Why? Because subject to deduction under section 24 class 1 at 30%. So 70% of the previous year unrealized rent, if recovered in this year, was taxable. Okay, thank you. We'll see in the next video income from business or profession. Okay, bye.